Hello, Uncle Jim here. What do you think the most profitable trade is? Well, today I want to share with you what I find to be the most profitable trade I can make selling options. I'm actually going to talk about the vertical put credit spread and how you can do quite well with it. So stay tuned. I think you're going to really enjoy what I have for you today. Okay, now before I jump into the key points for the video, I do want to talk about my weekly trades. This is something I've decided to do in each of my videos, and I've done 3 trades. It's currently Wednesday, and I did these earlier in the week with the exception of Procter and Gamble, which I actually did that today. And the first two, ASO and BBY, were both vertical put credit spreads. I was able to roll them out. So ASO was expiring this Friday. I rolled it out to November 18th and picked up $212. I also narrowed the spread from 35.25 to 33.25, meaning I don't need as much cash or margin. BBY, a similar situation. I rolled it not quite as far out. I rolled it to September 16th and I narrowed its spread a little bit too. It was 68.60 and expiring next Friday, and I rolled it out to, well, like I said a minute ago, to September 16th and did it at 67 and a half strike, and the farther out strike, or the farther outside the money strike, was at $60. So I picked up a little bit more cash and margin there, about $100. And then finally was Procter and Gamble. I did that today. The market was crazy up today and was able to sell a covered call. This is one contract. The other two were 2 contracts. I was able to sell the covered call expiring 1/20/23 and pick up $200 on one contract, which was really nice. And for the 3 of those, I did 617. Now, am I done for the week? Well, I've met my goal. I'm probably not done. I'm thinking I'm going to do one more trade and probably get in that $700 to $800 range for the week. So I like to share this. Please leave a comment below if you enjoy me sharing these kind of trades. These are all good companies if you're looking for companies to potentially sell options on or actually to purchase. These are 3 great companies to look at. So let's go ahead and jump into the next part of the video, and I'll cover the key points. Now, the key points with this video is how you can be really profitable. I'm going to talk about my favorite trade, which again is the vertical put credit spread. I talked about it with my weekly trades and how I rolled them, and it it can be the most profitable. It is a bit risky, but in I've had really good experience with it. Only a few I think have gotten assigned to me during the bear market. But before we get into the details about it, let me just try to see if I can define it for you if you're not familiar with it. So let's kind of break up the words. So vertical, why is it called a vertical put credit spread? How does the vertical come in place? Well, when you either sell a put or buy a put, it's both strikes are at the same expiration. So the put option you're selling is the same expiration as the put option you're buying, and that's where the vertical, comes. Now, why is it called a credit spread? Well, the option you're selling is closer to the money, so you're bringing in more cash, and the put option you're buying is farther out, so you're spending less money than what you're bringing in, so you're actually getting a credit. And then the spread is just the difference between those two strike prices. So in the example of my weekly trades, ASO 33.25 has a spread of $8, 33 minus 25, which gives you $8. And for one contract, again, you take that $8 and multiply it by 100, you need $800 of cash or margin, not including whatever premium you pick up to actually do that trade. So, that's primarily where the definition comes in. And what I like to do is I usually look at it first as a cash secured put. So even though I write vertical put credit spreads, I typically have enough cash to cover it like it's a cash secured put. But I look at I try to go out $5 or $10 and I try to find a put that's not too expensive that I can buy. And it's not always the one that's 10 out, it may be 7 out or 8 out. So if especially in the sense if you can get it cheap, then it's well worth doing the vertical put credit spread, mainly because you need such a small amount of margin in cash compared to a cash secured put. Um, and then with the fact that you need less margin, so again, let's use the example of ASO. You only need $800 to do one contract, and say you're doing it for a month and you pick up $100, you're getting a really good return. 100 divided by 800, I think, is 15%. Yeah, I believe it's 15%. I'm not real good on doing math at the last second, and that's per month. So if you were able to do that every month, you're talking potentially 180% return on that small investment. But again, it's hard to do it every month. But say you can do it 5 or 6 months out of the year, then again you're doing really well. 6 times 15 is 90, so that's like a 90% return. Or even if you do a little bit less, like say again we'll use the same ASO example, and you picked up only $50 when you needed 800, that's still a really good return. Um, so you can really increase your returns pretty majorly by doing a vertical put credit spread, and by doing that you're also able to free up a lot more of your cash and margin. You can actually write a lot more options. Now I do suggest that be really careful here. You don't want to take too much risk. I started out by doing like one vertical put credit spread trade, meaning I only had one contract. Then I went to two, and then I jumped to three contracts, per trade. And with three, it was too much. I was taking too much risk. I took a few losses, so I went back to two. And if it's an expensive stock like Procter and Gamble, then I'll only do one. Another example of maybe Apple or even Google. I'm looking at writing a vertical put credit spread on Google since it came down recently. I believe it went way up today. But you can do really well. I've had instances where I've done 10. I think I did the highest I ever had was a 14% return in 1 month on one of my vertical put credit spreads. So so that's primarily it. You can do really well, and you can actually roll them. And if you get the stocks, you're buying good value companies, and you get them at good prices, in my mind, it's a lot less risk. Now, if you're going for growth companies and you're going for broke, then you're taking a lot more risk, and you could end up getting hurt in the end. So those are the key points. I'm next going to share an actual vertical put credit spread that I've sold and share even more with you as I go through the trades so that it makes a little bit more sense. So stay tuned, that this next part of the video is going to talk about that. And as always, I do like to mention, please hit that like button, hit the notification, subscribe. I do have some Patreon memberships, and details are below. I encourage you to take a look, and it might be worth your while to give it a try. So that being said, let's jump into the next part of the video. Okay, it's actually the next day. It's Thursday, July 28th, I guess. Tomorrow's the last trading day of July. And what I've decided to do is to sell a vertical put credit spread in DVN or Devon Energy. It's a good company. It's got good earnings. I can show you the earnings real quick. So you can see it's doing quite well earnings wise. It also pays a good dividend. Let's go down and look at dividends. And here you can actually see the dividends. It's paying close to a 6% dividend. And it's been increasing the dividends kind of outrageously. Now, I don't know. A lot of this was a special dividend. So I believe it looks like 227. It'll be a little bit higher. So it's close to a 6% dividend. And if we look down here, we can actually see that the coverage ratio is good. So it's got good coverage. So overall, it's a good company. Now it is up a little bit today, but I can actually, I'll show you the option chain. So I'm actually looking at 29 days out, so a little less than a month, and I'm looking at, let's change this to Greeks, And what I'm looking at is the 50 right here, the 50, which is, or is it the 52? Actually, it's the 52, so it's 0.185, and it brings in over $1 in premium, which is pretty good. But I'm looking at also buying a put around the 45, 46 range. Um, so that's what I'm looking at. So this, I'll probably do two contracts. So let's actually jump into where I'm going to do the trade. So here, as I've mentioned in a lot of my other videos, I like to do market trades. I prefer to make my trade and be done. So here you can see it's actually a $5 spread. I'm going to bring in $53. So for less than a month, I'm going to get a 10% return. $500 of capital that I'm using and picking up 500 or $53 is pretty good. That's over 10% in less than 1 month. So I'm actually going to do two. So let's up this to two. And let's change this to market order 96. So it actually dropped a little bit, and that's partially because the market is up. You can see at the bottom of the screen, the market was down today earlier, but now it's kind of recovered. But $96 is still pretty good. So I think I'm going to go ahead and still do this. So the next step would be to, so I'm getting close to a 10% return, mainly because with two contracts, it's $1,000 of margin slash cash that I need minus the 96. So it's right there at a 10% return in less than 30 days. So let's review the order. And because of fees, it's a little less. So let's actually place the order. So there you see I was able to do it fairly quickly. I did a market order. Let's look at just today's. And here it is. So I did 108 minus 47. So actually, I think I did a little bit better. I think it was showing 103, 104. So clearly I did 108 minus 47. You're talking probably 52, 53 cents per contract, which again is over 10% in less than 1 month. So that's where you can really get the major profitability. You'll see someone like Warren Buffett will actually, since he's got so much cash to work for or work with, instead of doing say two contracts, he may do 1,000 or 10,000 or 100,000 contracts. And I believe Devon Energy is one of the companies he's invested in lately. Don't quote me on that. I don't remember exactly, but I believe it might be. But it's at a good price. If I could pick it up at 52, I'd be more than happy to own it at 52. And most likely it's not going to go. It doesn't move majorly. So if it does get pretty close to 52, right now I believe it's trading at 58, 59, I would probably be able to roll it. So that's partially, why I like companies like Devon and companies that pay good dividends, that have good earnings, that are doing pretty well in the short term. So I hope you enjoyed this. This is, again, one of my favorite trades. At times it can be really difficult to find the puts, right here, the puts that I purchased. A lot of times it's really hard. You'll notice a lot of people have purchased puts and they're can be quite expensive, but in the case of Devon Energy, it's worked out well. I've done a 10% return in less than a month, which would equate, if I was able to do this every month, it would be over 120% for the year. But to be able to do it every month is I think taking too much, and you're being too positive. If I could do this 5 or 6 times a year and get a 50-60% return, I'm doing quite well, and I'd be really happy with that. Thanks for taking the time to watch this video. Please leave any comments below that especially what you think of this trade, what you think of this strategy. I'd like to hear what your thoughts are, and is this one of your most profitable strategies too? So thanks for joining me, and I hope you have a wonderful day.